today we wanted to talk about something that we've been working on for the past couple months, and that is a special ebook that we're putting out. So, Emil, why don't you tell us a little bit about the ebook and what you're most excited about?
Yeah, look, the ebook, we've been working on it for a little bit now, and it's a collection of different articles that our team has written, essentially to guide advisors around how to use ETFs and maybe how to use ETFs and find them on our platform, and also explore portfolios of ETFs.
Awesome. Yeah. And so, why do you think it's so important that we're putting this ebook out, and especially right now?
Well, I think there's just a wealth of different choices out there when advisors are building portfolios or allocating assets for their clients. And there's just a lot of gotchas around, cost, total cost of ownership, taxes and tax loss harvesting. Um, there's obviously the backdrop of the markets. There's a massively shifting risk landscape. Um, you know, the markets that sort of economy that we're in now is very different than the economy from 9 months ago. So, how do you navigate this new world? How do you do it with the right tools?
So let's talk a little bit about the goals for the ebook, right? I think putting it out there, there's a number of reasons that we're doing it, but I think the most important one is to help teach, right? And CE, continuing education credits, offering those through our webinars is an important aspect of what we've been doing lately. But we wanted to take it a bit further and create a resource for advisors to help out with some of the other stuff that maybe we haven't gotten a chance to do on a webinar, or that we haven't dived too deep into, right? And I recently saw a chart on Twitter the other day that says, you always want to out teach your competitors. And it was basically a chart saying, you can sell, you can sponsor, you can promote, but it's never going to have the same impact as if you teach, right? And I think the importance of that is really around creating value for your clients, regardless of it being through your product, right? And so if we create value around this ebook, I think, that'll kind of drive a community that we're looking to get through our platform.
Yeah, I mean, that's spot on, Scott. I think, we're ETF experts. We understand a lot about sort of the quantitative aspects of building portfolios, how to look at risk, how to look at returns, how to look at costs and tax loss harvesting. So first and foremost, what you said, it's an educational resource that we're putting out there to help advisors navigate this world. Our obviously secondary goal is to let people know that a lot of the things that we're talking about in managing your portfolio, you can do through the Logically platform. We're not telling you to use the platform, but it will make your life a lot easier when you're thinking about all the different aspects of what it takes to manage a portfolio of assets, of ETFs specifically.
Awesome. So let's talk about the first article. It's one that me and you had worked on a long time ago, right? When I first came on, and it kind of fell away. We forgot about it. And then we just dusted it off recently. And that's the true cost of ownership, right?
Yeah, I mean, total cost of ownership is a way of, the way that we've put it forward is a way of explaining, a lot of the times when people think about investing in an ETF, they think, okay, well, what's the expense ratio? And immediately you'll sort by, lowest expense ratio to highest, and you'll say, okay, the one with the lowest is the best. But let's put that in context. If you're talking about a 3 basis points large cap ETF versus a 9 basis points large cap ETF, sure, that's a pretty big difference, relatively speaking, 6 basis points. But on a $10,000 investment, we're talking the difference between $3 and $9, which of course, over time there's a drag. But we need to put that $3 and $9 in context against all the other costs involved. So things like trading costs, just a round trip, uh, paying the bid ask spread could be already 3 or 4 basis points right there. So if you go for the 3 basis points expense ratio ETF, but you're paying 3 basis points to get into the ETF, well, that's 6 basis points right there. So those are just we can go through all the different costs like taxes and dividends and um, also the fund management, for example, how the fund is managed and whether those dividend yields or capital distributions are properly being disseminated. If the fund manager, for example, sends out a short-term or long-term distribution, then if that ETF isn't a taxable account, you will pay taxes on that, and you may not want that. A lot of people go to ETFs because of that innate, inherent, embedded tax advantage. So being aware of how the fund is being managed and whether it's paid, these special short-term, long-term gains or distributions, you'd want to be aware of that. So anyway, that's part of the total cost of ownership, and I think what we've provided is a very easy to read checklist. What you can go through and say, hey, does this ETF, is there a green check mark next to each of these points?
So for the rest of the articles, we kind of dove more into the portfolio analysis tools and some of the topics around there. Obviously, there's so much to cover given almost every grid that we have in that tool is almost like its own software in itself, right? So one of the other really important ones that I wanted to talk about was around tax loss harvesting, right? So obviously this year, we saw a lot of volatility in the markets. Right now, the investment outcomes that clients might have might not be the most ideal ones that they thought they would be at right now, given, at the beginning of the year, right? So why do you think tax loss harvesting is such an important topic for advisors right now and throughout this year in particular?
Yeah, I mean, a properly tax managed account can boost after tax returns by a substantial amount. Uh, Tax loss harvesting is a way of generating tax credits that you can use and carry forward to boost those future returns. With ETFs, because there's so many of them, there's 2,300 plus in the U.S. and counting. There's a lot of opportunities to take losses, basically do tax pairs trades, get out of one name, get in another that's basically very similar, maybe not identical, but similar, and maintain your policy, maintain your asset allocation exposures in a way that stays in line with the client's risk profile or expectations. Tax loss harvesting is something that people start to think about at the end of the year because of the tax year getting, coming to a close. But in reality, it's also something that you should be doing constantly. Whenever there's any losses, maybe below a certain threshold, you need to have tools that can go in and look at your portfolio and see that there may be potential tax credits and suggest potential tax trades or tax swap trades that you could do. So the article's goal is to talk a little bit about how to use ETFs for this and how to leverage our platform for identifying these types of trades.
Yeah, awesome. And so for Article 2, kind of ties into it a little bit in terms of ETF selection, right? And the tools that we offer. And that was the importance of choosing the right benchmark. Obviously, when you're searching for ETFs, right, a benchmark is one of the first things that you think about. But we dive a little bit deeper in it to talk a little bit about why it matters so much, and not for just the regular reasons that you might think about, right? So
Yeah, I mean, choosing a benchmark is always important, especially when you're running a back test or just you want to see how your portfolio is performing going forward. So we've done a lot of work on that on the platform with the ability to create customized benchmarks that really fit, that maybe suit the style of risk exposure that portfolio is that portfolio's policy is following. Um, so I think there's a lot of important details there.
So you mentioned the risk profile before, right? And that kind of leads into the other article that you had written, and it was about the risk landscape, right? And whether or not you need to take more risks to maintain income targets, right? So why don't you tell us a little bit more about that article and maybe how it ties into what we've been doing a lot recently.
Yeah, I mean, we're certainly not suggesting people take more risks, but what we are sort of bringing to the forefront is that income yields have dropped substantially. We're near zero rates. The Fed just announced near zero short-term rates till 2023. So we're in certainly a low-rate environment because of the way that the economy is progressing. Um, so when you think about traditional like 60-40 portfolios, that 40% is no longer, that 40% of fixed income exposure is no longer yielding what it did 10 or 15 years ago. And when you look at that sort of overall income generation from a portfolio based on risk of those different components, um, you're basically falling short a little bit from an income perspective. Sorry, let me do another take. So, um, if when you look at your portfolio from a 60-40 perspective, let's say 60% equities, 40% fixed income, what you've seen is that 40% portion returning, yielding a lot less. So to maintain sort of income expectations in the future, or especially if you're nearing retirement, you may want to think about higher yielding assets. So there are situations, for example, looking at some preferred shares. There's ETFs that pool different preferred equities. Preferreds are like kind of hybrid equities and bonds in a way. Um, and some of these preferred ETFs are yielding 5 or 6% with a lot less volatility than the S&P 500. Maybe a fraction of that volatility and risk exposure. So it may be possible to shift slightly your fixed income exposures towards preferred equities. And we have some other ideas in the article that we mentioned. Yeah, I mean, we're certainly not suggesting people take more risks, but what we are sort of bringing to the forefront is that income yields have dropped substantially. We're near zero rates. The Fed just announced near zero short-term rates till 2023. So we're in certainly a low-rate environment because of the way that the economy is progressing. So when you think about traditional like 60-40 portfolios, that 40% is no longer, that 40% of fixed income exposure is no longer yielding what it did 10 or 15 years ago. And when you look at your portfolio from a 60-40 perspective, let's say 60% equities, 40% fixed income, what you've seen is that 40% portion returning, yielding a lot less. So to maintain sort of income expectations in the future, or especially if you're nearing retirement, you may want to think about higher yielding assets. So there are situations, for example, looking at some preferred shares. There's ETFs that pool different preferred equities. Preferreds are like kind of hybrid equities and bonds in a way. Um, and some of these preferred ETFs are yielding 5 or 6% with a lot less volatility than the S&P 500. Maybe a fraction of that volatility and risk exposure. So it may be possible to shift slightly your fixed income exposures towards preferred equities. And we have some other ideas in the article that we mentioned.
So moving on from some of the topics we covered that deal with our portfolio analysis tools, we also covered an article where we talked about model portfolios, right? And as many know, model portfolios are new, but they're becoming more and more used by financial advisors for a number of different reasons. So we broke those down in that article. That's part of the ebook. But Emil, what do you think is the biggest driver, in your opinion, of advisors leveraging model portfolios?
Yeah, I mean, I think that advisors need ways to streamline their workflows, and the rise of models is really kind of two stories. One is that relentless focus on sort of optimizing and reducing the amount of time on, let's say, portfolio asset allocation, and increasing your time as an advisor with your client and focusing on their financial planning, which is, maybe a much bigger task than just portfolio and asset allocation. So that's the first driver. And then the second driver is obviously ETFs. We've seen, models have been around for decades, but ETF models have also been around for decades, but we've seen more and more of them because, again, there's 2,300 ETFs and there's just so many ways, the possible combinations are infinite of how to put these different things together. So it's been a great way to take advantage of the low cost, the tradability, diversification of ETFs, while also reducing, optimizing your workflow as an advisor.
So some of the other articles that we covered in the ebook were a little bit more practice management related, right? The first one being about how you can leverage technology. So, in this new world that we're in, no longer can you go and, take your client out to lunch or take them out to coffee, right? So everything is on Zoom, right? Everything is video, screen sharing, or via telephone, right? And when you're having so many Zoom meetings, if you're like us, you're probably pretty zoomed out by now, and your clients are as well. So we talked about some ways that you can go ahead and leverage the visuals from our platform or, from technology in general to kind of spice up those meetings and keep your clients engaged.
Yeah, I mean, you mentioned it. It's all about the charts and the numbers, and this space can be overwhelming. There's just a ton of stuff that you feed some system your portfolio, and you can get this flood of analysis. So we want to be careful when we built and designed the platform. We wanted to make sure that like the most important things were brought to the front. So if you're looking for a quick understanding of what the risk and return is on your portfolio, what just the expense ratio is on a blended basis, you can get those numbers like pretty snappy. If you're a power user and you want to drill down look at like Sharpe ratios and Sortino ratios, we've got that too. So we have all these little bits of information, but we've also kept it all very highly visual. So you've got pretty bar charts and pretty line charts that look really good on an iPad if you're on the road and you want to show someone what portfolio A looks like versus portfolio B, and all that stuff gets generated out in PDFs. So you could print it out and have all those visuals, have all those charts, or even just select the charts you want. So you can customize that PDF in a way that makes it like a great talking point, great conversation starter. Yeah, exactly. I spot on, and that sort of understanding of how to build those user interfaces and making sure the user experience is a positive one comes through working with advisors, sitting with them, seeing how their existing tools are failing them, and figuring out how to do better. And that's kind of how we build, logically.
Awesome. So that kind of wraps up all the articles we touched on a little bit. So for advisors who are interested in any one of these articles, number one, you can download the ebook by going to logically.finance/advisors guide.